Hi, everybody. My name is Jamie Fleming, and today we're going to be talking about the 8 biggest money mistakes even the most successful business owners make and the habits to overcome them.
So, why haven't you reached financial freedom yet? Well, today you will learn exactly what money mistakes to avoid so you don't compromise your hard-earned success and legacy. You will walk away with clarity about winning financial habits that will give you the confidence to advance your business and grow your personal wealth at the same time. I work with highly successful women executives and women entrepreneurs. My ultimate desire is empowering entrepreneurs in general, but more about empowering women entrepreneurs. There are all kinds of stats about women and money. We know that women are master manifestors, but in working with women and money for 30 years now, I know there's still a huge gap between generating 7 figures or more in our businesses, but not having that translate into personal wealth at the same level as our business success. And there are a lot of statistics around this issue. One of them being that women in the middle and upper income levels are surging in their level of debts over women at lower income levels. This money is a money stat that we'll talk about today, that making more money doesn't mean more wealth. It's the very reason why I wanted to share these money mistakes and the habits to overcome them. So let's get started. If you've been investing for a while, or even if you're just starting to invest in your first retirement program, you need a plan. When do you want to retire? What are your other financial goals? How much will you need to match your desired lifestyle? What kind of rate of return do you need to achieve your goal? When do you plan to take Social Security? One of the most important parts of a plan is an investment policy statement. This includes writing down your goals and when you want to achieve them. Note how much risk you want to take in terms of what percentage invested in stocks, bonds, real estate, business, etc. This will help you visualize your plan. Above all, you have to run some numbers. If you haven't done that yet, how do you know how much you need to put away today to get to your financial goals tomorrow? If you're working with an advisor and they haven't run those numbers for you, how does the advisor know how to recommend and invest appropriately for you as an individual and an entrepreneur? I come across this often when new clients come to my office. If they've been working with an advisor, I ask if they have a financial plan already. Most of them say they do, but when I ask to see it, more than not, the comments are, well, it's not written down. You can see the potential for disaster here, right? Or at the very least, how are you going to know how your goals are progressing if you don't have something to compare it to? As successful entrepreneurs, are you sitting here today feeling like your business is wildly successful, but your personal finances may not feel quite in sync yet? If the answer is yes, or even gosh, I'm not even sure, then I need you to know that you're not alone. There is good reason for that. You're running an empire. Your time is limited. You put your personal needs last, behind your business, employees, family, and maybe even other close relationships. I get it. But I promise you that by the time we finish today, you'll have a clear and powerful next step you can take to start allowing your business success to translate into personal wealth you've always thought possible. A family at the same time creates little margin for self-care, including your money. This is where my 30 years of experience of building a practice based on my clients' needs during the accumulation years has helped so many people, especially entrepreneurs just like you. I can relate personally to many of the mistakes I'm going to talk about today, so I get it. I am fortunate to have amazing clients who actually help me create the financial business model I have today based on what their financial needs were. From getting my certified financial planning designation in 2002 and then starting my own independent registered investment advisory firm in 2003, I was able to create financial success for my clients and myself. Because of the earlier financial mistakes I made personally while building my business, I was able to develop a system of habits that my clients and I rely on to create and maintain financially healthy businesses and personal wealth. So today, you're going to learn the 8 mistakes entrepreneurs make and the habits to overcome them. Beyond what you're going to learn, I also want to give you some affirmations and permission, because when it comes to money, we don't always get it right all the time. And I need you to know that that's okay. Today's takeaways: it's okay to admit You don't have enough time to focus on all aspects of your finances, both business and personal. It's okay if you've made financial mistakes in the past, as long as we learn from them, right? I call this financial tuition. And lastly, understanding the importance of focusing on and growing your personal wealth and family legacy as much as you're focusing on and growing your business. So if you can, for the next 30 minutes or so, turn off all your distractions. Hopefully you have your favorite beverage in hand and be ready to think big about your personal finances. So we know just because you're sitting on a pile of money doesn't mean that you know how to manage it. Even millionaires blunder when it comes to preserving their wealth. From over 30 years of experience and observations, high net worth clients frequently make the same mistakes that less well-heeled people make. Early on, when I was making high six figures in my 20s, even I deferred certain financial responsibilities to my partner at the time and lost sight of the bigger picture. I knew better, but I didn't do better. It wasn't until one day I went to the mailbox and found out we had credit cards and the debt to go with them. This was a terrible surprise to me, as I had never carried credit card balances before. And to be completely frank and honest, I didn't really handle it all that well. I had been working very hard building my business just to find out we had mid-5 figures of debt. But the reality is, I was more upset with myself for allowing this to happen by not taking a more active role in regards to my personal finances. I just figured I'm making enough money, we should be fine. I see this with my clients too, and perhaps some of you here can completely relate. So here are the 8 common mistakes even millionaires make. Number 1, failing to diversify. This mistake was made by nearly everyone, although they might not even know it or realize it. For years, many considered their home as their primary investment. The collapse of 2008 showed what a bad idea that was. Others invested exclusively in their company's stock or the next Microsoft. Diversification means having vehicles that move in different directions. That means a mix of stocks, bonds, real estate, commodities, collectibles, and business interest. If you're not able to diversify that broadly, make sure you do have coverage in many asset classes and continue to look at diversification in the future. Failure to diversify a portfolio is widely regarded as one of the most common investment pitfalls. Spreading your money around is a vital tool to manage risk. However, it must be used correctly. Diversification will only add real value if the new asset has a different risk profile. Here's a case study to consider this idea. I was working with this client for over 2 years on various financial matters, but also helping him reallocate so he could retire early at age 50. And because he had 90% of his portfolio with the company stock he worked for, I had been educating him on the importance of diversification for over a year. And it didn't matter how great the company was. To have 90% of their portfolio, which at the time was about $500,000, with one company put him at a huge risk if something were to happen. He actually went to one of the owners to discuss my recommendation because he was emotionally attached to the company and the company stock. The owner basically told him he had a smart advisor and that he would not have invested 90% in his own company if he had a choice. The client finally allowed us to divest methodically, but also as quickly as possible. He kept about 100 shares of the company stock because he wanted to maintain a sense of loyalty, even though it likely didn't matter one way or the other to the company. This was roughly in the year 2000. Less than 2 years later, in 2002, the company in question, Kmart, actually filed for bankruptcy, and the remaining 100 shares were literally worth nothing. So imagine if he didn't divest the way that he had done. He was lucky. This happened very soon after we made those recommendations. He would have had to continue to work. As it had it, he did not continue to make the same mistake, and that allowed him to retire early and travel and do all the things that he really wanted to do. Number 2, investing without a plan. It is not uncommon for new clients to come to me with a bunch of stuff, right? Including investments, insurances, etc., but with no plan. At some point, they realize they don't know what everything is supposed to do, if they're doing enough in each area, and or if they're missing anything. Without a plan, they have no way of matching up what they're doing with what they want. This is like taking that dream vacation around the world without a map. You will likely make it around the world, but holy cow, there are bound to be things that take you far out of your way or even end up in places you have no reason being for safety reasons. This is not that different when it comes to your finances and your financial goals and financial health. Number 3 is letting fear interfere, emotional decisions. It always surprises me how most people invest. They have a gut feeling about a stock. They are sure the stock market will go down. They think their company is the best in the world. These are just some of the lies we tell ourselves. And then, of course, there's the big one, fear of failure. I like showing extremely successful people out in the world because people assume because they have a lot of money that they don't make some of the same mistakes we make. So it's hard to predict markets. But even comedian Margaret Cho counts missing out on a hot real estate deal as one of her top financial mistakes. What held her back? Fear of failure. In 1994, Cho had the opportunity to purchase a friend's apartment in Manhattan for $400,000, which probably felt like a lot of money then. Despite having the money, she turned it down because she felt it was too risky a proposition. That home today is worth millions. Years later, she was offered a partnership in a restaurant for an investment of $25,000. She could afford it again, but her fears got in the way again. Those owners have since sold the businesses and have quit working and, of course, are traveling around the world in their yachts. The lesson here is do a proper analysis of each investment opportunity that comes your way. Take into account market research. Ask yourself, what is the actual likelihood of failure? If I were to lose my investment, would that derail my financial plan? Is it a relatively small risk for a potentially big reward? The best way to strip emotion from investing is to craft a rational plan that matches your risk tolerance, then stick to it. This is where we do things that will help you analyze your risk with the clients that work with us to help you determine which investments actually match your risk tolerance. Number 4, not seeing the bigger picture. The strength of your financial plan is measured by your investments and your income security. In 2008, as the stock market was headed on a downward spiral, Sally Krawcheck spoke with her financial advisor. She wanted to understand the impact a serious market correction would have on her investment portfolio, but she failed to analyze the implications beyond that. Krawcheck lost value in her retirement savings, which she anticipated. What she didn't anticipate, she also lost her job on Wall Street and a big chunk of her net worth, which was tied to her company's stock. What she failed to do was to continue the train of thought, to look and say, okay, what would happen to the stock market, to the stock of the bank I was working at, if there was a market correction of that size? What happens to my employment possibilities? Well, we know what happened there too, out of a job. The lesson, the strength of your financial plan is measured by your investments and your income security. This is a very big deal with business owners because if you are the income generator for your business, then you're also the income generator for your paycheck. So it's worth it to check in once in a while and ask, what if? What if you lose your income? What if your investments take a nosedive? What if it all happens at the same time? Diversification among your investments and income streams proves critical in down market. As for owning a piece of your company, as Krawcheck did, a good rule of thumb is to not have more than 10% of your portfolio's value in your company's stock. If you own more, just be sure it's not heavily tied to your overall net worth. By the way, this is important because she was considered one of the best analysts on Wall Street. So just seeing that and knowing that, we all have our blind spots. Number 5, turning a blind eye to your finances. Of course, I wish I didn't have a personal story here, but I'm not the only one. And this happens a lot with successful entrepreneurs, even while generating high levels of revenue. When you have significant amounts of revenue coming in, it's actually easy to not notice the financial inefficiencies that can end up costing you thousands of dollars. Fitness guru Jillian Michaels says she was intimidated by money, and that caused her, regrettably, to just hand over her finances to various professionals. She feels like this cost her dearly on so many levels, and she explained that one person overpaid what she considered an obscene amount of money on her taxes one year. This person didn't bother to understand the structure of her corporation, so she double paid on a high percentage of her income that year. And she didn't know it because she didn't understand. She didn't bother to look. She didn't know what she didn't know. The lesson here is hiring a planner and a tax professional is worth the money to do so to achieve your money goals. It is a must, but turning a blind eye to your money management can be a costly error. You want to hire professionals that understand how to work with entrepreneurs and create cohesive professional and business plans for you. So you have to make sure you're working with the right person. Number 6, not investing in your future. Sure, your business is fueling your personal success right now. If you've reached the break-even point, chances are good that you've tapped into that income to pay off debts, to invest in a new home, to buy a new car, or otherwise improve your personal situation. That's fine, but don't go too crazy. As I regularly talked about, real success is more about your total net worth than it is about how much you pull in per year or how nice your car is. So don't forget to take steps to maximize your net worth over time. So we're going to look at 2 large purchase mistakes within this arena. So this case study talks about large purchase mistakes made even by the most successful entrepreneurs and high net worth individuals. So we're going to look at a car purchase. This cash purchase led to a $30,000 financial mistake, and not for the reason you're probably thinking. So this woman entrepreneur has been wildly successful, and she bought a brand new, when we did this last year, a 2020 Mercedes-Benz. This was her dream car. The purchase price was $100,000, and she paid cash, and she felt great. Now, when she came to me, she had already purchased the car, but just recently. So we knew that she qualified for 0% financing for 72 months or 6 years. Here's the opportunity cost by paying for something lump sum versus investing lump sum. So the $100,000, if we invested that for 6 years for growth at 8%, that would have given her a portfolio of $158,687 versus investing the monthly payment of the car payment, which would have been $1,389 per month for 72 months at 8%. The portfolio would have been approximately $128,665. This was a $30,000 mistake because of how she purchased the car, not because she purchased the car itself. So statistically, people buy a new or different car every 3 to 4 years. This is a lot of money for a depreciating asset versus investing for growth. So think about the everyday millionaire. On average, drives a 4-year-old car with 41,000 miles and keeps it for 8 to 10 years. Imagine if you invested the car payments or cash you're paying over your lifetime. Even for the everyday person, this is an area that could easily increase your net worth and in turn, your financial success. The other large purchase mistake is looking at home purchase. And again, had another new client a few years ago, and the new client had just paid $500,000 cash for their new home, which was a good portion of his net worth, about 75%. So negotiating with cash was not the mistake, as he made the home purchase and beat out higher offers because in this case, the seller and buyer wanted to quit close. In looking at the client's financial profile and other financial goals, including cash flow and spending analysis, I propose the following. Let's do a refi of the house of 80% of the home, which is $400,000. Take out a 15-year mortgage at 3% at the time, giving him monthly payments of $2,762 a month, which was doable cash flow wise. Total payments over 15 years, $497,218. Total interest payments would be $97,218. In doing this, the interest write-off actually placed him in a lower tax bracket, so his net interest expense was actually much less. Then we invested the $400,000 at 8% for 15 years. That gave him over $1.2 million, versus if we had invested the monthly amount he was making on his mortgage instead, that would give him $962,000. This would have been over a $306,000 mistake, right? And in addition to that, his home will be paid off in 15 years and its worth will probably be around $900,000. So just looking at how to make large purchases throughout your lifetime could actually end up increasing your net worth by, as you can see, large amounts, 6 figures at times, not to mention the tax savings you might be getting as well. Every year before we schedule our clients' annual review, we ask them what major purchases are in store for them so we can figure out the best way to make those purchases. Our motto is, tell us what you're thinking about doing, not what you've already done. Number 7, failing to review your portfolio. Creating a portfolio is not like riding a bike. You don't do it once and think you can do it the same way the rest of your life. Look at your long-term portfolio once a year at least. Rebalance it if it veers from the investment policy statement that we talked about earlier. If you fiddle with it more than that, you're likely to make some bad decisions as well, especially if they're coming from an emotional place of the market being down on any given day. Your future investment situation is likely to be different from time-aged averages. Past averages may have little bearing on the current environment and therefore the actual returns you receive. Number 8, focusing on the past. You can't predict the coming year based on last year's returns, but most people refuse to believe that. They pick stocks and mutual funds using that erroneous perspective. Nobel Prize winner Eugene Fama, who won the award for his work in financial economics, says to get a clear picture of how a stock or asset performs, you would need to look at least 35 years of past returns to be accurate. More than not, the biggest winners of the prior year are not so in the following year. This is the common behavior of buying high and thinking the stock will continue to do so. So why do we make these mistakes, even when we're aware of them? Well, we look at the psychology of money. Yes, there is a psychology of money, and it is heavily attached to our values. Our values are actually the keys to ultimately unlocking our financial power and thus our financial success. But it's difficult, if not downright impossible, to achieve our financial goals if we're making financial decisions that are not in alignment with our values. If you were to achieve any kind of success that was contrary to your value system, you probably would not be very happy about your success and in turn, not feeling very successful at all. Your values about money will define and determine everything that's important to you in your financial situation, how much you need, how hard you're willing to work for it, and how you feel when you finally get it. Once you understand what's important about money to you, you can't help but achieve your goals. And let's face this simple reality. No matter how successful you are in business, if you spend more than you make, then your personal financial health and well-being are in jeopardy. If you're simply generating 7 and 8 figures in revenue and you need to do so to support increasingly expensive lifestyle, then your personal health and wealth may be sitting on a financial house of cards. So are you standing in the way of your own financial success? Maybe you don't even realize you are because your business is so successful. The reality, not paying attention to your personal wealth may be just the thing that sneaks up on you when you have a moment to look up and appreciate all the hard work, realizing you haven't done all the little things every day to build, grow, and protect your personal family legacy in a way that truly reflects your business success. I've been advising wealthy clients for 30 years now, and although their habits may vary to some extent, depending on how they acquired their wealth, there are 3 main everyday habits that my wealthiest clients have in common. These habits tend to be true even though their road to financial independence differed. Habit number 1, yes, big ticket items such as big houses and expensive cars can sometimes come with a wealthier lifestyle, but my most successful clients' biggest expense is their commitment to savings. In fact, my most affluent clients consistently save 25% more of their gross income annually. Industry standard recommends saving about 15 to 10% of your gross income, then increasing it annually or when cash flow permits. I agree with this strategy as a starting point and recommend this technique to my clients quite often. If you're not saving anything right now, 10% of your income is an excellent place to start. But if you're looking to understand the habits of my wealthiest financial planning clients, those always start with a more aggressive savings rate. When I look at my most successful clients, they've managed to maintain the savings rate even at various levels of income, from those extremely high annual earnings to retirees who don't receive earned income at all. Creating this habit early on is a major key to having a high net worth of investable assets going into retirement when your money needs to work for you versus you working for your money. Habit number 2. It is quite clear as I work with this group that more wealth casualties are sustained trying to maintain wealth than accumulating it. Once you obtain wealth, you have to protect it from not only bad investment decisions and market volatility, but other casualties such as overspending, longevity, inflation, and even frivolous lawsuits. So habit number 2, these clients are great at understanding and managing risk. Okay, so unfortunately, protecting your wealth can sometimes come at an exorbitant cost. As certified financial planning professionals, we are taught to brace our clients for the high cost of long-term care insurance, for example. But this is only the beginning. You might also need disability insurance to protect your income, life insurance to safeguard assets from estate taxes, and an umbrella policy for additional personal liability protection, just to name a few other protection mechanisms. And if you're a successful entrepreneur, there are risk management tools to protect your business and your family if your circumstances change dramatically. The list goes on, and each of these products adds an expense to maintain, but that cost could be minimal compared with the impact of actually needing some of the coverage but not having it. Habit number 3, the most successful clients and business owners, they have a team of experts on their side. Though more and more people are tackling things themselves by using Google and YouTube when it comes to finances, my most successful clients seek help from experts. A professional wealth building team typically consists of an attorney, a tax expert, an insurance expert, and a financial planner and advisor expert. While these professionals can help you by providing expert advice and tangible action steps to follow, sometimes the true value may lie more in the intangible factors, including helping you control your emotions. No matter how wealthy you are, losing your cool can happen to the best of us. My most successful clients lean on us to help them separate those emotions and make sound financial decisions. Providing a clear roadmap when there are endless paths to explore. My most successful clients value receiving comprehensive financial plans specific to their goals and situations. They use these plans to help prioritize their goals and to create cash flow strategies that maximize savings or optimize distribution strategies. In addition, they lean on these plans to assess their risk exposure, keeping up with rapidly changing financial and legal landscapes. In the field of finance, things are forever changing because of new legislation, groundbreaking research, and new products. Since December 2017, we've had the most legislative changes our industry has ever seen. Some of those recent legislative changes include the Tax Cut and Job Act that was enacted in December 2017, the Setting Everything Community Up for Retirement Enhancement Act that was enacted in December 2019, and the Coronavirus Aid, Relief, and Economic Security Act passed in March 2020, as well as additional acts and amendments to that passed as recently as earlier this year in 2021. These have all caused financial planners to reevaluate and in some cases pivot from prior recommendations. This is only after we have made ourselves familiar with the new laws, which can take countless hours of research. At the end of the day, my most successful clients are very consistent and committed, and they use a team of experts to accomplish their most desired financial goals. Once you're clear about your goals, then it's time to bring in the cavalry. An example of my entrepreneur client that wasn't maximizing her tax planning strategies until I did a discussion with her CPA about something totally unrelated. This 20-minute phone conversation resulted in the client increasing her annual retirement contribution from the prior maximum of $35,000 to $92,000. We also managed a first-year tax savings for her corporation of an additional $34,960 without changing her personal cash flow. Now imagine, we didn't just do this the first year. We did this each year for the next 15 years, creating a portfolio of over $1.6 million while saving her business over $500,000 in taxes. That was a ton of information. So let's just do a quick review. Let's look at the mistakes: failing to diversify, investing without a plan, letting fear interfere, not seeing the big picture, turning a blind eye to your personal finances, not investing in your future, and failing to review your portfolio and focusing on the past. We looked at how psychology of money influences our choices with money. You are what you think, right? And if you spend more than you make, your personal and professional financial health may be failing. And then lastly, the 3 habits of my wealthiest clients. Saving is their number one priority. Also managing risk and utilizing a true team of experts to achieve their goals. You deserve to know how your business can truly transform your reality with money. This is how I work with clients to get them from financial uncertainty to financial freedom. Number 1, we are going to thoroughly review your business finances and make sure you're making strategic decisions that elevates your profits and aligns with your long-term goals. Then we're going to thoroughly look at your personal financial needs and wants and make sure you're not putting all your resources into your business. And then lastly, we constantly monitor and reevaluate as we go so that actions taken on your behalf always best serve your needs for now, for later, and for the loved ones you'll eventually leave behind. How would it feel to be completely confident in your financial management of your business success and your personal wealth? You can make this happen and take advantage of powerful financial strategies right now. When we work together, your path to financial success is clear and focused. Your personal wealth becomes a priority, and your income can support the life you always dreamed it would. So what's next? Schedule a complimentary consultation with us. Get a complete review of your business financial goals and personal wealth. And lastly, know exactly what can be done for your business and personal wealth to grow successfully. Letting your business create and preserve your personal wealth doesn't have to feel like a fantasy. You're working too hard for your business to not make your personal financial security a reality for you. So avoid the mistakes that will undermine your success. Understand your barriers, but don't let them stop you. And adopt simple and healthy money habits that make you accountable to your dreams. I want to thank everyone who is here today or listening to this on the recording.
If you have questions and/or are just ready to move forward, schedule a complimentary consultation by using our scheduling link at https://jamielfleming.cfp.as.me/book-a-consult. I would absolutely love to work with you in achieving all your financial goals, both personally and professionally. Let's get started.